Let me share my biggest struggles when I first started trading. I had very little self-control, and I was unable to resist the temptation to overtrade and to overleverage. If you're in your first years, you're probably facing the same issues. So today I want to reveal the several tweaks I've made to save my trading. So like, subscribe, and stick around for the full video. There is a special appeal to trade against the trend or against a big momentum price move. The main reason is the illusion of an attractive price. A market that has been going down for many days, by definition, is going to have a relatively low price, and you're tempted to buy it at this low price. The danger of these seemingly attractive prices is an important law of trading. Continuation is more likely than change. From my experience and many losing trades, high tends to indicate even higher, and low usually means even lower. This was one of my biggest mistakes. I took far too many trades against a powerful price move. I haven't kept records from the beginning, but I've definitely lost far more money on these trades than I've made, and it's probably true for you. But even more damaging than the amount lost against these momentum moves were the profits not realized, because I've missed several good trades with the trend. Trading against the trend will misdirect your focus, and as a result, you'll miss many entry points for profitable trades in the direction of the main trend. Against the trend trading has a tendency to be addictive, and this will bring other problems. When a trade against the trend goes against you, you'll initially say, "I was a little early with my timing," and there is a strong temptation to try again and buy or sell more at what now has become an even more attractive price. So never add to a loser if it's against the trend. My mentor had a funny saying, "If you think you reached the bottom of the ocean and you can't go lower, remember that you can always dig the ground." The same with trading. If you think the market reached an absolute high and it can't go higher, you'll have a big surprise. When you trade, you need to know what the time span you will most often act upon. If you are a short-term trader and find it difficult or impossible to hold positions for several days, and instead get in and out frequently, then you have to adjust your trading style accordingly. If you are a swing trader and hold trades for longer periods, regardless of the short-term price movements, then you need to use a trading strategy to capitalize on these tendencies. You need to know your patience level. If you know you are patient, then you'll be able to endure the inevitable fluctuations in your swing trades. If you know you are impatient, you will end up trading shorter time frames. The shorter the time frame you decide to trade, the more intense concentration you will need to sustain. So, if we consider once again trading against the trend, the only possible way to succeed is to be a short-term trader as well as be very selective. I mean only entering when momentum is clearly in your favor. And one of the worst trading styles is to be a long-term swing trader who trades against strong trends. This combination will inevitably result in consistent big losses. So know your time span and your level of patience. The first decision to make when designing your strategy is to decide which currency pairs, cryptocurrencies, or stocks you will be trading. Because I said it many times before, not all strategies will work on every market. Trading price action on Tesla is very different compared to Bitcoin's price action. So, if you're in your first years, it's better to become a market specialist. And as a specialist, you will concentrate on one market. I have a friend who trades only one market, the pound dollar. I know him for 10 years, and he never traded anything else. It sounds radical, but this works for him, trading just one currency pair. This comes with the understanding of the market, knowing the factors that affect the market, and of course, a solid strategy for different phases of the market. When you are focusing on one market, you will also learn the correlations associated with that market, when the market is reacting in an unusual way, or when it's trending or not. If it's too radical for you, monitoring just one market, have a maximum of 3 markets and make them your focus. If you have a hard time trading, try narrowing down. It might help you. Do you have a weekly maximum drawdown? You should. This is the amount you are willing to lose over a period of time. An easy way to measure the maximum drawdown is to look at it during one trading week. You may risk 1% of your account on each trade. If you set your weekly maximum drawdown to 5%, then you can withstand 5 losing trades in a row. After 5 losing trades, you have hit your maximum drawdown for the week. This is when you stop trading because you reached your maximum drawdown. This is the best way to avoid over trading, revenge trading, and over leveraging. Now, how you decide to apply the maximum drawdown rule may depend on the time frame you decide to trade. If you are a scalper or an active day trader, you may need a maximum drawdown amount for one day. That maximum drawdown will affect how many trades you'll be able to take at any given time. For example, you may decide to have a maximum drawdown of 5% for each trading week. But if you have 6 daily signals on the first trading day of the week and you risk 1% on each trade, you could have a drawdown of 6% in your first day. So to avoid reaching your maximum weekly drawdown on your first day, you should reduce your risk. Instead of risking 1% per trade, you risk 0.5% per trade, or even lower. A popular concept in trading is to wait for confirmation before entering a trade. This means you have a signal, for example a price action pattern, and you wait for the markets to confirm that pattern before you enter. The idea, of course, is to filter out bad trades and to gain confidence before entering the trade. When planning a trade, there are 2 basic approaches. You can anticipate a move, or you can wait for confirmation. Both methods have their pros and cons. Anticipation can provide better entries with less certainty. Waiting for confirmation provides higher certainty at the expense of a later entry. Let's say you're monitoring this specific support level. Price is aggressively moving towards it and closed in this area with a big momentum red candle. You wanted to buy here. You patiently waited for price to reach this area, but with this red candle, do you enter? The risk to buy into a support level while the market is in free fall is risky. But that's precisely why these trades offer you great profit potential. You anticipated the move and you were rewarded for the risk you took. The conservative traders would have waited for a confirmation. They would have entered after a rejection candle. But they already missed the initial price move. And that move may be over, and those who took the risk and bought at a support level are now potentially taking their profits. The point to consider is that whenever you wait for confirmation, you give up potential profits. And there's the other side of the coin, where price broke that support level with ease, and traders anticipating a bounce are now at a loss, while the conservative traders are the winners in this situation. Your job here is to find a good compromise between getting in too early due to a signal coming from market noise and getting in too late due to a signal that misses most of the opportunity. It's a hard task, I know, and it will take you some time to find the balance. But when you'll find it, trading will become a lot easier. You have a tool on your side to assist you in giving trades the time they require to turn into winners. That tool is stop loss placement, and more specifically, using wider stop losses. Many traders are naturally tempted to place a small stop loss on their trades. They think that a smaller stop loss distance means a smaller risk, and that wider stop losses means they are risking more. But it's obvious that it's the contract size or the number of lots that determines the risk per trade, and not the stop loss distance. The stop loss distance is nowhere near as important as the position size you are trading. The position size determines how much money is risked per trade, not the stop loss distance. The fact is, many traders don't take into account the market noise. Market noise is simply the price data that distorts the picture of the current trend. This includes small corrections and intraday volatility. You say you're minimizing risk and use a small stop loss, but you don't take into account random price spikes that may occur. Giving a trade even another 30 pips, for example, can significantly improve the chances of that trade flipping from a loser to a winner. Ask yourself, what's better, placing 10 trades with small stops and losing on most of them, or placing 2 trades with wide stops, winning big on one and taking a loss on the other? The second strategy is the one you should follow. Remember, wider stops will keep you in the game longer and improve your chances over a series of trades. Trades don't often turn out exactly as we want them to. This affects our emotions because we are wired to want instant results. There's a difference between what we expect from a trade and what a trade actually gives us. A common mistake is to expect some unrealistically big profit on nearly every trade you take. You are a day trader, but you place profit targets that are 200 pips away from your entry. And when this target doesn't get hit, you experience emotional pain and distress. And here's another bad mindset. You often have unrealistic expectations of how long a trade will take to play out. I'm also guilty of this. I want every trade I enter to immediately go into profit territory. I'm mostly a swing trader now, and I would love a 100 pip move in my favor in my first day. But if the average daily range is only 60 pips, that would be unrealistic. A trade can sometimes take several hours or days to play out, depending on your time frame. And you need to keep this in mind because you will never make money if you don't give the market the time to move in your favor. Next time you place a trade, you should be prepared to see it out and let it run for days or weeks if it needs to. If you're a swing trader like me, don't get scared by intraday fluctuations against your position, and don't exit too early, as you may miss out on potentially strong trend moves. It's also very important that you understand that each day and each week, the market can only move so far. So don't have unrealistic expectations of how far your trade might move in a certain period of time. Now, these are only a part of the measures I took to improve my trading. If you want to learn other tips and tricks to be ahead of the game, make sure you watch this video. Also, check out our Academy program if you want to further level up your trading. Until next time.